The Kentucky Small Business Development Center is a statewide, nationally accredited program that provides no-cost, confidential business coaching and training services. Whether you're just getting started or are ready to expand, we have the tools, resources, and expertise to help you succeed. We're part of a national network, America's SBDC, with over 1,000 centers across the nation. To learn more about how the Kentucky SBDC can serve you, please visit KentuckySBDC.com or email us at info@KentuckySBDC.com. You can also reach us by calling 888-414-7232. Thank you for joining today's webinar. The chat feature is available for you to ask questions and interact with today's speaker. Please take a moment to introduce yourself and where you are watching from today.
Welcome, everybody. Thanks for joining us today. Welcome to another Wednesday webinar. I'm Dave Etkin. I'm the director of the Louisville Center of the Kentucky Small Business Development Center program, and we are one of 17 centers throughout the Commonwealth of Kentucky. So again, just as you heard, if you wouldn't mind, just say hello in the chat to your right there. You'll see it. And tell us your name and where you're joining us from. So we see Michaela from Fishervale. Hello, Michaela, and Vicki from Beattyville, over in the eastern part of the state, I think. Good to see you guys. Hey, Rachel. How are you, Rachel? Rachel's a good friend of mine. So, it's January, and of course, on January 2nd, the first thing on everybody's mind is, man, we got to get ready for taxes and get everything's in order. And what can I do last minute to mitigate some taxes and get things set up and make it a smooth tax season? Joining me today is my great friend Joe Johnston with Dean Dorton. Joe and the Dean Dorton team are a great resource. I personally use them in many, many ways. They're a great bunch and super knowledgeable. So Joe, welcome.
Hey, David.
So Joe, I'm just going to jump in and hand it over to you, and let's just get started and talk about taxes because it's on my mind. So Joe.
All right. Thank you all. Appreciate everybody attending. Again, Joe Johnston, and we're going to talk about taxes, something that's near and dear to my heart. I've spent the last 25 years actually doing taxes for other people and myself. Always been a passion and a love of mine, working with small businesses as well. So we'll just jump in and go ahead and get started. Today, we're going to talk a little bit about the CARES Act, some of the things that are still going on with those. We're also going to talk about planning and updates for the year end. And then briefly on Build Back Better, as I'm sure most of you have followed, it has pretty much not gone anywhere at this point. So I'll convey some information specifically for small businesses that I think still may be relevant. So the CARES Act, and I'm not going to read these sides verbatim. As we all know, the CARES Act came in on March of 2020 now. Huge bill, a lot of components. We're going to talk a little bit about some of those. Some of those, the stimulus checks and other things aren't going to apply. Some of the temporary modifications to the TCJA we will talk about. Most of those have already expired, so there's not a lot there, but I would like to just give you a little bit of information of what's going on with that. The first thing I want to talk about is the PPP loan forgiveness. At this point, the program's closed. All of the loans that were going to be given have been given. So now you're probably starting to get notices from the bank saying, hey, it's time to do your PPP loan forgiveness application, either the first loan or the second loan or both. I've still got clients that are dealing with first loan, and I've got clients that have submitted their second loans. The IRS came out with a Revenue Procedure 2021-48 that provides guidelines on when and how to deduct the PPP loan forgiveness. And as I think everybody knows, just as a quick primer, the loan is not taxable and the expenses related to the loan were deductible. That was originally under contention. That was all resolved by Congress. So now the question becomes is I've got this loan. It might be sitting on my balance sheet as a loan. I've pay the expenses against that loan. When do I take the loan into income? How do I take it into income? And then what do I do? And this 2021-48 basically goes into the detail about what to do and how to do it. Basically, the best way to do this is to match expenses with income. So if, for example, you had a PPP-1 loan in 2020 and you had those expenses that you used the money for, you should have brought that loan into income in 2020 and against the expenses. If you didn't, that's okay from a tax perspective because, again, it's not taxable. If you're a flow-through entity, an S-Corp or a partnership, the thing that you do want to make sure that you're doing with the PPP loan and the forgiveness is that you're picking that up as an increase to basis. So that as you own an S corporation or a partnership, you put money into the company, that gave you basis. You earned income, that gave you basis. You take money out, that reduced basis. So in order to keep this revenue neutral with the PPP loan, what Congress basically said is that is an increase to basis, even though it's not a taxable income event. So that's just something to think about and let your preparer hopefully is aware of this and is doing that. And then the timing, again, the best timing for this is to match income with expenses. So to the extent that you deduct expenses in 2021, you should recognize that non-taxable income in 2021 as well. The same for 2020 and 22. If you did not, for example, if you don't want to pick it up and you want to wait till you have forgiveness, that's fine too, because that's one of the allowable methods. So basically, you can match expenses and income. You can do it when the application is filed, or you can do it when you actually get forgiveness. And I know the forgiveness portion on some of these loans has taken a while. That I know the SBA is backed up and a lot of the banks are backed up. We had one that took roughly 6 months before we got the forgiveness letter. So I know there's some timing there. That's why for most of my clients, what I'm recommending is if you're 100% certain that you spent the money appropriately, then I would take it into income in the year that I had the expenses. Okay, the other big piece of was the employee retention credits. So the employee retention credits, is I think everybody's heard about, was the ability to be able to get credits for up to 50% of qualified wages, not to exceed $10,000. For wages that were basically from 3/13/20 to 9/31/21. It was actually supposed to sunset at the end of 12/31/21, but Congress pushed that because the economy was doing better. Congress chose to terminate the program early on 9/31/21. So the nice thing about this is you can take this credit, and I've got some slides a little bit later talking a little bit more detail about the credit, but you can take this credit even if you took a PPP loan. Originally, when this credit came out, you couldn't take the PPP loan and the retention credit. You had to pick one or the other. Congress backed off that and said you can do both, but the key point here is you can't use the wages that you use forgiveness for the PPP loan to be able to take ERC credit. So it really has made this calculation pretty complicated. I know there's a lot of, we can help assist with making the calculations and the determinations. And I know a lot of the payroll companies have reports in their systems, ADP, Paychecks, Payroll Solutions, et cetera, have some reports that will help you do with this, but know that this is pretty tricky and the complicated calculations. The good news about this is you can actually go back for 3 years. You can go from 3 years from now, you can still go back and take this credit. So there's nothing that immediately has to be done. You have the ability in 2022, 2023 to take this, to get these credits if you qualify for them. Just another quick note, at the end of 2020, you were allowed to do a payroll, Social Security tax payroll deduction. You didn't have to pay that money in, and the government was going to let you defer that for into 2021 and 2022. So just to let you know that first 50% is due So you might be, the IRS I know is sending letters that basically saying that if you, whatever you deferred, that a portion of that is due. So just keep in mind that if you did do any kind of employer payroll, Social Security deferral, that first payment is due, and then you'll have another payment next year. Then we're going to talk a little bit about the CARES Act changes to the TCJA. And again, most of these have already expired. I just want to give you a heads up about what's going on and what's happening with those. So the excess business loss limitation for individuals, trusts, and estates, that is now back. Now that was indexed for inflation. So for 2021, if you had a loss singly of a $262,000 or $524,000 married filing joint, you will not be able to use any loss in excess of those two amounts against any other income. So let's assume in this example you had $100,000 worth of wages and you sold some property and had another gain of $200,000. So you had a $300,000 of income, and a business that you had owned lost $300,000, and you were single. What that would basically mean is that you can use that full $300,000 loss to offset the other $300,000 worth of income. Your loss on the business would be limited to $262,000. And then you would have to pay tax on the remaining $38,000. So that's just something to keep in mind if you have that. There's a lot of complications around that and how you track for that and then how you treat it. This will be in effect until 12/31/2025. However, just as a little look into the Build Back Better, the Build Back Better actually proposed to make this permanent so that you would only ever be allowed to deduct business losses against other income to these indexed amounts. So there's some nuances there, something to think about as far as moving forward if you're having losses and how you use those losses in the size of the losses that you may generate. All right, net operating losses, new rules for Schedule C's, corporations. I don't know how many Schedule C's and we have on there. So this is going to be mainly for the individuals. You could have carried the net operating losses that you had in 2018, 2019, and 2020 back 5 years. So again, it's something to contemplate. The fact that the previous limitation, the business limitation did not apply during 2018, 2019, and 2020. And this ability to carry losses back 5 years is pretty important if you were generating losses in 18, 19, and 20 because of COVID or as a result of not being able to be in business and having expenses. The intention of the government was to allow you to carry those losses back 5 years in order to get refunds to be able to use to help you in your business. So again, from a planning perspective, looking at this while we're into 2021, and this doesn't apply, but from my perspective, it's just something that you need to be aware of. And if you had those losses, sitting down with a tax advisor and making sure there's the ability to carry those losses back, if that gives you the best outcome. So just something to think about, make sure that you did. Qualified improvement property. Again, I know a lot of people may or may not have heard this. This is kind of accounting speak. When they originally did the TCJA, they made a mistake in writing the law, and the CARES Act fixed that. So that basically the issue is that for bonus depreciation, which is where you can deduct 100% of the expenses of qualified property, the rule when they did the language that they used in the TCJA did not contemplate that property being eligible for bonus depreciation, and the CARES Act fixed that. So again, if you had qualified improvement property that you put into service in 18 or 19, and you did not take bonus because at that time it wasn't allowed, there was some accounting method changes that you can do to allow you to go back and take that accelerated depreciation on those qualified improvement properties. And what that would technically do then is allow you maybe to amend those returns and get the carry back. So you need to talk with a tax advisor about that, but just to make sure that you're aware of that as well. Again, this just talks about what qualified improvement properties are. I'm not going to get in a lot of detail of what that is. Business interest expense limitation, again, that was put in under the TCJA that basically said, to the extent that I'm a large business over right now, roughly 26 million, we'll talk a little bit about that later, and I had a lot of interest expense, I couldn't use that interest expense to offset my income. So my interest expense was limited to 30%. I think my slide's backwards here. My interest expense was limited to 30% of my taxable income before the interest expense. The CARES Act increased that to 50%, but that expired in 2020. So we are back to the 30%, not back to the 50%. Apologize about the mistake on the slide, but again, to the extent that you're a larger business and have debt with a lot of interest, this is another issue that you need to be aware of, and also be aware that the interest deduction limit went to back to 30%. Again, corporate minimum tax credit acceleration. I don't know how many C Corps that we have, individuals on this presentation that are in C Corps, but to the extent that you are a C Corp and you had alternative minimum tax credits, they were allowing you to accelerate those credits to get refunds. Again, at the time that the CARES Act was passed, the whole thought process was to get as much cash into the hands of business owners as possible. So they made very favorable rulings in order for you to be able to do that. Individual tax provisions, again, just real quick for all of us that are individuals, required minimum distribution. So when you reach age 72, you're required to take money out of your retirement accounts. That was suspended. Again, under the CARES Act for 2021, it was now in place. So you had to take those required minimum distributions by December 31st. Also remember that under the COVID, if you took money out because of a COVID-related issue in your retirement plans, you could elect to defer the tax on that for 3 years. The second installment of that is due. I also want to let you know you can still repay that. So again, if the maximum was $100,000. So let's assume that we took out $100,000. We took that $100,000 out because of a COVID-related issue. Somebody had COVID, etc. If you elected to take $33,000 of that into income last year, you also have to take $33,000 of that into income this year and $33,000 of that into income next year and pay the tax. But at any time within the next 3 years, you can pay that full $100,000 back or a portion of that $100,000 back, and you won't have to pay the tax on that. You got to get into how you're going to go back and amend the returns to get the money back if you made initial payment last year or this year. But it's something to keep in mind. That's a real great opportunity for you to be able to refund a retirement account if you took the money out, because that's not the most efficient way to borrow. The IRS and the government recognizes that. So this ability to pay it back over a 3-year period is really a taxpayer positive situation. Again, charitable contributions. Again, you can get 100% for all charitable contributions. So again, that is expired, but to the extent that you made charitable contributions in 2021, you can offset 100% of that income. For those who do not itemize, there's a $300 and $600 above the line deduction. Last year it was only $300 whether you were married or joint. This year, if you're single, it's $300. If you're married, it's $600. It's for cash donations only. And the IRS, I will say that the IRS and Congress has said they don't want everybody just dropping $600 on their tax return if they don't itemize, that they do intend to ask for verification for this. If and when they do that, I have no idea. All right, just to talk a little bit about planning and some updates. So I'm gonna. That's a long slide with a lot of words, and if you read from top to bottom, some of it's contradictory, right? So just in general, when we talk about tax planning, normally what we talk about is the ability to be able to defer tax from one year to another. There's very few times where you can really limit or not pay tax or get a permanent deferral or a permanent reduction in taxes. Most of the tax savings that I deal with are deferrals, and that's taking the tax that you owe and pushing it to a future year. So when we talk about that, how do we talk about achieving that? Well, some of the ways we talk about achieving that is, do we have expenses that we need to make in January or February in our business that we can actually just cut those checks if we're cash basis in December, so that we're going to get the deduction in December and that way reduce taxes that we owe in April. So that's part of that is, can we move expenses into the current year from a future period? Again, this has to be legitimate expenses, stuff that we need to buy. Let's say we need to pay rent. Maybe we pay that early. Let's say that we need to buy supplies. We normally, go to Sam's in January. We go to Sam's in December, and we get that deduction in the current year. So from my perspective, that's the way that you reduce taxes in the current year by increasing expenses. The other thing is like revenue recognition contracts. Let's say we're not billing our clients in December. We hold off. We bill them in January if we're accrual basis, or if the work's complete, of course, you have to recognize the revenue. But to the extent that we can postpone the billing, maybe we can push that revenue recognition into the next year and not pay tax on it this year. And again, what that does is it keeps more money in our pocket for a period of time, and less money goes to the government. With some of the other stuff we talk about, and I got the next slide I'll talk about, is under the TCJA, the government expanded the definition of a small businesses for the purposes of accrual based versus cash based. If you were, in most circumstances, if you had inventory and you were over $5 million in gross sales, you had to be on the accrual basis, which means that you had to recognize revenue when you billed versus when you collected the cash. You could deduct expenses when you received them versus when you paid for them. But most of the time hopefully you have more revenue than you have expenses. So being on the accrual basis, in essence, accelerated income into a year that you may or may not have collected the cash. Under the TCJA, what Congress did is expanded that definition of small businesses and up to 25 million originally, indexed for inflation. And what basically meant that if you were if you had inventory or had it otherwise be an accrual-based taxpayer, and you were under that $26 million, you could elect to go on the cash method. Now, to elect to go on the cash method, you had to file a 3115, and you had to do some calculations. But the benefit that gave most of the clients that are our size is that you could postpone recognizing income on receivables. So if I had a situation where I had $1 million worth of receivables at the end of the year and I didn't collect any cash on those, if I elect the accrual method, or if I elect the cash method, I don't have to recognize the income on that $1 million. I recognize the income on it when I receive the cash. So it's again a deferral of that. So I can do that with the cash to accrual. Then there was also some for uniform capitalization for those who have to do UNICAP. It's a calculation that your CPA or your accountant does every year based on your inventory. You didn't have to do that. Again, to the extent that one of the biggest tax savings advantages that I tell people about is if you look at your CapEx budget. So here's the things that I'm going to need to buy. and I'm going to need to buy a new printer, or I'm going to need to buy a new piece of office machinery or a new piece of equipment. And I think I'm going to do that within the next 3 to 6 months into 2021 or into 2022. What I would normally tell my clients is if you know you're going to need to buy it and you need it, go ahead and buy it by year end. By doing that and getting that piece of equipment in service, you get a deduction. And with the bonus rules, you can deduct 100% of that. Again, it's taking something that you need for your business and pulling that into a current year in order to help you with your cash flow. And I'm going to take a step back here real quick. When we talk about tax savings and we talk about planning and all these ideas, one of the things I always want to talk about is never let the tax tail wag the dog, right? Do what's best for your business. And if we can find something from a tax perspective to help cash flow that, we will. But you should never do things just to try to save taxes. That in the long term, that's not good for you or for the business. So I will always say that, do what's best for the business first. Talk with your tax professional before you do those things to try to figure out if there's a way that we can marry the two and you can do what's best for your business and get a tax deduction. For me, that's the best win-win. Again, a lot of these are accelerating expenses, electing. And then again, if you look at the bottom, it talks about pushing expenses off into the next year. And the reason that in this slide, we're talking a little bit about this, right, is because now we're into this situation where we think taxes are going to go up. So if you think taxes are going to go up in 2022 or 2023, then the question becomes, do you really want to bring expenses into 2021 at a lower rate, or do you want those expenses to be pushed out into 2022 where the rates are theoretically going to be higher? So that's part of kind of the calculus you have to do is, where do you think future rates are going to be? How do you think those are going to impact your business? And then do I want to do just basically the opposite of everything that Joe just said, push expenses out, bring income in? So I want to pay more tax this year, less tax next year, because I'm going to pay more tax this year at a lower rate. My personal thought on that is I never try to do tax planning based on what I think will happen. Will taxes go up in the future? Absolutely. Will they go down in the future? Absolutely. They always do. If you look at tax law since my career, we started at 28%. We went all the way up to 39.6%. We've come back down. We instituted qualified dividends where, ordinary dividends were at ordinary rates and qualified dividends were at capital gains rate. So they're always tweaking with rates the way things are. So trying to plan based on what they may do, to me, it's just problematic and it's hard to do. So I normally try to take the tax savings when I can in the year that I can. So just food for thought there. And again, just talk about this small taxpayer designation. Again, what this basically says is that if you are in this year for December 31st, 2021, if you're under $26 million, you can be, for tax purposes, for accrual versus cash, for uniform capitalization, for the way you treat inventory, and for the interest expense deduction that we talked about earlier, you can be on the cash method. You don't necessarily have to track inventory. You don't have to do unit cap. And that interest limitation doesn't apply to you. So being under that $26 million threshold can have some real tax advantages. Now, just real quick, that $26 million threshold is cumulative. So if you have multiple businesses, so if I have 3 businesses that I'm in control of, and the IRS has a lot of rules about defining what control is. But let's say I have 2 businesses, one does 13 and one does 14, and I'm in control of those. Cumulatively, we have $27 million worth of gross receipts. Neither of those businesses can then qualify. You can't spread your businesses out to qualify this. It's cumulative based on all your businesses. But to the extent that you have a business that's small, that's under this $26 million, there's some real tax advantages for you and something you need to be talking about with an advisor. Bonus in Section 179 for 2021 for last year and for this year, bonus is still at 100%. So again, to the extent that I buy qualified property, which is basically anything that's not 39-year property, I can deduct 100% of that when it's installed and in service. That is going to drop to 80% in 2023 and will phase out so that by the end, under current law, will phase out so that by the end of 2025, it'll be zero. Now, it's funny because bonus has been around since 2003 now, and it's been scheduled to phase out multiple times, actually phased out a little bit for a couple years. And we had a year where we weren't eligible for bonus, but they always seem to bring it back. Again, the whole theory behind bonus depreciation is that it incentivizes you to go out and buy equipment, which then incentivizes the economy because you're spending money and they're trying to get you to spend money. Section 179, just a quick step back. Bonus is not Kentucky. If you're in Kentucky, Kentucky does not conform to federal depreciation rules for bonus. So in Kentucky, you cannot take bonus depreciation. Section 179 is another ability to expense. It has some more rules and complications than bonus. So normally what I would tell clients is do bonus to the extent you can. If you can't do bonus, we'll look at 179. You can expense up to $1,050,000 for 2021 under Section 179. So again, normally I would tell you take bonus. If for some reason you can't take bonus, then you look at 179. The only caveat I'll tell you with that is Kentucky now allows $100,000 of 179 expensing, which is up from their $25,000. And there's no cap on that. No matter how much equipment you buy, you can expense the $100,000. So you have to kind of look at maybe what you want to do is take 100,000 of 179 for federal, so you can get the 100,000 of 179 for bonus. Now, technically, you can take all bonus and then just take 179 on the Kentucky asset. To me, that gets a little complicated. I just like to, if I'm going to do something for bonus for federal, I like to, as much as possible, do it for the states as well. So what I would recommend is, again, in order to get this benefit to Kentucky, is take $100,000 of Section 179 for Kentucky purposes and then bonus the rest, if that makes sense to everybody. Restaurant meals, just a quick reminder for 2021 and 2022, businesses may deduct 100% of the cost of food and beverages provided by a restaurant. Now, they defined a restaurant, and basically they said a restaurant is a business that prepares and sells food or beverages to retail customers for immediate consumption. It doesn't mean you can't carry out. You can buy it as long as the restaurant is normally in the business of selling food and beverages to customers. With that, there's this caveat here that basically said grocery stores are not going to qualify because they don't primarily sell, even though they have, a lot of them have cafeterias or hot tables. That's not going to qualify. It has to truly be a restaurant. And if a company has its internal cafeteria, that is also not going to qualify. Those rules were changed again under the TCJA because a lot of these big companies, Microsoft, et cetera, had these in-house chefs and in-house kitchens, and the government didn't think that was fair, so they did away with it. And when they changed the rule, they wanted to make sure that they were clear that those still are not going to qualify. So again, to the extent that you're doing entertainment and you're taking clients out, to the extent that you're buying meals for employees, you this year, last year, and this year, you'll get 100% deduction for those amounts. Self-employed retirement plans, just real quick, to the extent that you have a business and you're not potentially otherwise in another retirement account, you can start a retirement fund for yourself and or your employees. If you are in a business with employees, if you do it for yourself, you must do it for them as well. What I can tell you from a post-year-end planning, a SEP, a self-employed plan, you can actually create those plans and fund them after year end. Any other kind of retirement plan like a 401k or a solo 401k, those all must have already been created by December 31st. So to the extent that you're thinking about putting some money away for retirement, the SEP right now is the option that you have to be able to defer paying taxes in 2021 via retirement. Just a quick side box on this, retirement planning and retirement contributions are probably the best deferral that I can get my clients. Because if you think about this, if I put away $20,000 into a SEP, I'm not going to pay tax on that $20,000. So my income is going to be $20,000 lower. And if I'm in the 20% tax rate, that's $4,000 of tax that I don't have to pay. So if you think about this, the IRS and the government is basically subsidizing your own retirement. So not only are you not paying tax on that, that money is then being used by you to fund your own retirement. So for me, maximizing 401ks, maximizing SEPs, making IRA contributions, we can have a conversation about Roth versus traditional, but getting that tax deferral and the ability to fund my own retirement is, to me, a win-win, especially if I can get the government to pay a little bit of it. Credits, I'm going to talk about not in detail. I'm just going to give you a couple credits that I see for smaller businesses. The energy credit, again, these are kind of give-me's in my opinion. So if you buy an electric plug-in vehicle, the government will give you $7,500. There's a list of what cars qualify. You go to the IRS's website and type in plug-in vehicles, and they'll give you a list of all of the vehicles that they currently will qualify. If you buy one of those, you can get a $7,500 credit. Not a huge fan of this. Last time they did it, people went out and bought those golf carts and off-road vehicles, and they got them street legal, and they all cost amazingly $7,500. And then basically the government paid for you to have a dune buggy. Research and development credit, probably, again, one of the best credits that you can get if you do research activity. Now, just, real quick, that doesn't mean lab coats. In rocket science, the IRS has definitions about what qualifies. If you're at risk, if you're developing or designing something that is new or making improvements to something that you've already done and there involves risk, potentially you could qualify for the R&D credit. I have a client that designs fire suppression systems. And while all of the materials for that fire suppression system are kind of off the shelf, the design of how that system works within the building, that design then qualifies them for R&D credit. So there's a lot of areas that you don't think about that qualify for R&D credit. So again, it's something that if you're doing anything kind of innovative, creative, especially like in construction, in manufacturing, in software, it might be a conversation with somebody about the potential to look at the R&D credit. A lot of boutique firms do R&D credit. They'll take a look for free and they'll tell you whether you do or don't qualify, and then you can kind of move for there. But from my perspective, a great credit, and really should be something that small businesses avail themselves of if they qualify. Just a quick note on that, to the extent that you are doing research and development under the TCJA, basically those costs that are related to that credit are going to have to be amortized over 5 to 10 years. The Build Back Better was going to defer that until 2025. Since it hasn't passed, so effective for this year, if you do have R&D related expenses, you will have to capitalize and amortize those over a period of time. You won't get an immediate expense for them. The Work Opportunity Tax Credit, that's been around for probably a decade now. Plus, again, to the extent that you qualify for that, to the extent that you're hiring people that meet the qualifications for this, it's a credit. It's something you need to be talking with your employees about upon hiring. If you're using a payroll company, again, a lot of them have an onboarding process that will help kind of identify these. This is also a credit you can go back and look at and amend if necessary. So something you might want to consider taking a look at. The employee retention credit, again, here's more of the details about what qualifies for that. I'm not going to get into the details. Okay, last section to cover before I start taking questions. Build Back Better. The largest provision of the Build Back Better that impacts or will impact most of my small clients is this net investment income tax. Under President Obama, when the healthcare law came into effect, in order to help pay for the cost of that, they instituted this 3.8% net investment income tax. And what they said was that if you are not actively involved in a business that's a flow-through business, you have to pay an additional 3.8% of that in earnings on that business if your total income was over $250,000 if you were married or $200,000 if you were single. And it only applied to passive businesses. So if I was an investor and bought into a business and I really didn't do anything with the business, at the end of the year I got my K1, I was considered passive, and therefore I had to pay 3.8% on the income of that business, my share of the income of that business. It also applied to all interest, dividends, stocks, anything like that. If I sold shares of Apple and I was over this $250,000, I had to pay in addition to my capital gain of 20% or 15%, I had to pay an additional 3.8%. What the Build Back Better bill has proposed was that 3.8% apply to all pass-through businesses. So whether I actively materially participate in the business or not, any income from that business, in addition to the regular tax that I would pay on that, I would be subject to the 3.8% tax if my income levels were over that. And again, that's total income. So if I got a W-2 and I had some investment income and that, total $250,000, and my flow through from my partnership or my S Corp was another $50,000, I would then have to pay an additional 3.8% on that $50,000, because in total I was over $250,000. To me, that's probably the biggest impact to small businesses. There was other provisions that have gone in and gone out. There was talk about the QBI, qualified business income deduction, the 20% deduction. There was talking about capping that. That was removed. So there's been some provisions that have been taken out, put back in. The biggest sticking point right now is the SALT deduction. And for those of us who are not in low-income states, Kentucky being at 5% being a pretty low-income state, the SALT deduction wasn't as hurtful as for those in California and New York who are paying 10 and 11% in state income tax. So again, that's something that is a sticking point. The Democrats want it brought back in. The Republicans want it still capped at that $10,000. There was talk about raising that up to $80,000 to help, some people. So I don't know where that's going to go. The other surcharge, again, that is going to hurt individuals, but these were high income individuals. So they added 2 additional surcharges. One for 5% if your modified adjusted gross income was over 10 million, and then one for another 3% if your income was over 25 million. And I know that seems like a lot of money and very few people will be subject to that. But one of the things I want to note is a lot of people have trust, and those income caps for trust are only 200,000 and 500,000. So if you have created trust to do some estate planning and to do some wealth management, those surtaxes can really come into play. Because if you think about this, if you're in the top bracket of 37%, if you have a trust and the trust makes $500,000, it would already be in the top individual bracket of 37%. It would now, and if it was a business and it was an operating business, it would now pay a 3.8%. So it would now be in the 40.8%. And if, again, it made over $500,000, it would be another 8%. So now you're talking about 48.8% federal tax alone. Then you would add another, let's say 5% Kentucky. And then if you looked at in the city of Louisville or one of the counties in Kentucky that pay tax, so somewhere about 1% to 2%, you could actually be somewhere in a 50+% tax bracket. So from a small business perspective, this can be potentially pretty hurtful. Just real quick, talk about the status. President Biden was and all his people were on the talk shows over Christmas saying after basically what happened is they thought they had a deal. Manchin basically, I think on the 15th or 16th said, nope, can't vote for it. So it kind of crumbled. So the president and his people have been back on the talk shows and the news circuits saying, I think it's going to be passed. Here's what I can tell you. It's extremely difficult to pass tax legislation in an election year. Nobody wants to vote for a tax bill and then have to go back to the constituents and say, yep, I raised your taxes. Please vote for me. So you're probably not going to see anything happen this year. Again, who knows? Again, with the Senate being 50-50, you have Joe Manchin out of West Virginia, and you have Christine Sema out of Arizona, both Democrats, but they have objections to a lot of portions of the bill. So getting them on board, I think, is going to be problematic, especially again in election year. So I would not expect to see, if we get any tax increases this year at all. So you're looking at maybe 2023 before we could possibly pass anything. Last point, there was some talk about breaking the bill up, but I think procedurally, that's just not going to work. So you're either going to pass it or you're not. And again, I do not foresee passing it in 2022. You can quote me on that. In about 2 months, I'll be wrong. Sorry. But that's kind of where I'm at. So again, from my perspective, kind of wrapping this up holistically, looking at tax planning for 2022, I would assume that 2022 is going to be the same as 2021, which is the same as, last year, that the TCJA provisions are going to remain through 2025. So most of the TCJA provisions that are beneficial to small businesses expire on 12/31 of 2025. I don't think there's going to be any changes in those for 2022. And my gut is, if you believe what they say about how the House and the Senate may change in November of this year, you're definitely then not going to get a tax bill in 2023, which means you're not going to get one in 2024. So you literally may not see anything happen until the next presidential election cycle. You have to take that with a grain of salt, considering how much money the government spent to try to deal with COVID. Our deficits are high. Yes, at some point, tax revenue is going to have to increase to be able to deal with that. So that's kind of just my crystal ball look of what I believe is going to happen. Again, always subject to change depending on the economy and the election cycle. That's all I have. I don't know if there's any questions.
That was a lot, Joe. So yeah, folks out there, if you have any questions, just put them in the chat and we'll get to them. I do have a couple questions myself, though, and I'm curious about the SEP program. How hard is that to set up and administer? Do you have to hire somebody to do that for you? Or?
For a small business, it's literally easy. You can go to any bank, any brokerage house. Actually, I set up one for my wife. I went to fidelity.com, clicked on retirement, clicked on SEP, did it all online, never talked to an individual, never did anything. So SEP's they're simplified for a reason. They are fairly easy to start. The thing you just have to keep in mind is that if you have employees, if you make a contribution for an owner, you have to make the same percentage contribution for your employees. But super easy to set up, and there's no reporting requirements for SEPs like there are for 401k plans.
Mm-hmm.
So again, it's just an easy way to get some money set aside for retirement.
So is there a minimum number of people in the SEP program that you have to make it?
Oh, you can have one. If you're a sole proprietor and you're the only, so in my wife's case, she has a small business. She has no employees. So we just make the SEP contribution for her.
Interesting. So Mary says, who can qualify for a Roth IRA?
So again, if you have income and you're not a part of a retirement plan, so if I'm a W-2 employer and my employer does not offer a 401k plan, I then would qualify for a Roth. I could set up a Roth account. Again, kind of the same methodology used to set up a SEP account, and then I can make a Roth contributions. I think the limit this year is still $66,000 or $6,500. If I'm in a employer provided plan, so if I'm in a 401k plan or some other type of retirement plan, then I can make a Roth contribution or a traditional IRA contribution based on income limit phase outs. And those phase outs start around $75,000 for single individuals, and I think go up to about $150,000, $175,000 for married individuals. You'd have to look at where your income is and what the limits are. But anybody with a job, you have to have earned income from a job, from a business, can do a traditional retirement, an IRA or a Roth as well.
Okay. Some of these you were talking earlier about the loss carry forwards to for over the couple of years, and again, I don't delve too deep into taxes, but were there some of the carry forwards that had to match passive income to passive loss, and you couldn't use the losses for active income?
Yes. So, and that's the rule, and that rule hasn't changed. So the government, the IRS, the Treasury has three buckets of income that everybody kind of has to live with. The first bucket is your investment income. That's stocks, bonds, interest, all of that kind of thing. They have another bucket for other income like gambling winnings or lottery winnings or other stuff like that. But for the most part, you have three buckets. You have your investment income, which is what you would think about stocks, bonds, interest, dividends. You have earned income, and that is active income. So that's my W-2 wages. So I go to work, I get a paycheck, I earn that money. I work in a business, I earn that money. I'm there, at least 500 hours a year. There's some tests. There's 7 tests. The big one is the 500-hour test. The third bucket is passive income. That's investments that I've made that aren't stocks and bonds, that I don't actively participate in that business. So again, I go out and I buy a rental house, and I hire a company to do the rental house for me, and they do all the maintenance and they do everything. I just bought it as an ability to hopefully cash flow. That is considered a passive activity. And to the extent that I have a passive activity and that passive activity generates a loss, I can't offset that loss against my active business income. So you have to kind of look at that as 3 buckets. The business loss limitation that was implemented basically said, to the extent that I have any business, whether passive or active, and that business generates $500,000 worth of loss, more than, again, originally $500,000 worth of losses, $250,000 for singles, I can't use that to offset other income, either passive or active or investment. Just a step back, to the extent that I'm active in a business, traditionally I can deduct that active loss against any other kind of income.
Okay. That's always been a little confusing, but thanks for that,
It
Joe.
really is. I mean, if you're a business owner, then you have to start looking about how active you are in the business, and there's those requirements that I be active in the business. Again, the main one being that 500-hour rule. So if I have 3 businesses, I need to at least work 500 hours in each one of those businesses. Mm-hmm. If I don't, one of those businesses could be considered to be passive. And what the IRS does is if you have a loss, they're always looking, because if you have income, right, you always pay tax.
Right.
If you have a loss, they're always looking for a way to not let you use the loss.
So it's the way the game's played.
The way the game's played.
So, folks, if you have any tax questions, now's the time to throw it out there. So please do. I was wondering, though, I think that like the Section 179 and bonus depreciation is a great opportunity for small businesses, no matter how small you are. Maybe you could talk just a little bit about what are those qualified properties? You know, like in one of my businesses, we did a bunch of renovations, and we were able to use that, and we've offset all our taxes for the next several years. So what else could a business use?
Yeah, so the IRS has class lives. So they have 3-year, 5-year, 7-year, 10-year, 15-year, 20-year, 27.5-year, 39-year. So bonus eligible property, and I'm going to paraphrase, is basically any property that's not 27 or 29-year. So if you think about it from a non-commercial building or residential building perspective, any equipment that you buy for your business, computers, conveyor systems, presses, anything like that is going, office furniture, fixtures, all of that is going to be bonus eligible.
Vehicles,
yes, absolutely. Trucks. Now, vehicles, if they can be used for non-business use, so like if I go out and buy a Camry, right, and I can tool around town in that, I have to be able to substantiate that it's actually used in my business. But if I go out and buy a dump truck, most definitely I can deduct that for my business.
Okay. And while we're on the subject, define 27-year and 39-year property for us.
Yeah. So if I go out and buy residential property, so a house or an apartment building that is used for residential purposes, that building I have to depreciate over 27 years, or that house I have to depreciate over 27 years. So if you think about that, it takes a long time to get any benefit for that. If I have commercial property, a hotel, a commercial office building, an industrial building where there's a manufacturing, the building itself has to be depreciated over 39 years. So it's even a longer period of time to be able to depreciate that. So just, as a side note, if you have commercial or residential, there's something called a cost segregation study. And what that cost segregation study allows is for you to kind of take that building and break it down into components, parts, which then would allow you to reclassify some of that 39-year property to those lower classes, which then would allow you to be subject to bonus depreciation. So in your example earlier, you talked about doing renovation. So let's say I renovate an office building. What I can theoretically do is, because a lot of those renovations aren't structural, and to the extent that they're not structural, they should qualify for a shorter life. And to the extent that I can qualify them for a shorter life, I then am allowed to take bonus depreciation against that. And to do that, you need a cost segregation study. And there's a lot of firms out there that will help you put together your cost segregation study.
Yeah.
And normally the cutoff for that is about $1 million, again, depending on the type of property. So if you have something that costs about $1 million, it's probably a good idea to look at a cost seg.
Okay. Yeah, that's, I know it sounds daunting, but it's a great opportunity to really save on some taxes, because you can pay zero taxes for an extended period of time if you take the time and do it right. So yeah. I highly recommend digging into that one.
Absolutely. And again, it is daunting, but if you get with the right professionals, the processes to do that are really streamlined now. The cost is pretty effective against the benefit that you receive. So again, it's having a conversation with your your tax professional. And what I'll tell you just real quick, always talk to your tax professional before you do something. It's a lot easier for us to plan before you do it than after you do it.
That's right. Good advice. It looks like we're at the top of the hour, and I don't see any other questions. So, Joe, this has been spectacular. I've really learned a lot today. I really enjoyed it. You're a great speaker.
Well, thank you, and I appreciate you all staying with me for an hour.
Everybody's thinking about taxes, right?
Everybody's thinking about taxes.
Well, thanks, everybody, for joining us for another Wednesday webinar, and we'll see you next week. And so have a good Wednesday. And, Joe, thanks again.
No problem. Thank you all, and you'll have a great day.
See you. Bye, everybody.
Thank you for joining today's webinar. At the Kentucky SBDC, we know small businesses are the heart of our economy. That's why our goal is to help business owners start, grow, and succeed in Kentucky. Find out more about how our no-cost business coaching, training, and resources can help your business. Visit us at KentuckySBDC.com.